Hey folks, what's going on? This is Shadow Stars coming in for the third part of my earnings thoughts on AMC's Q2 earnings. I'm actually going to try to keep this video shorter. A few people that have watched these videos and reached out to me have said that's a little long. So what I'm going to try to do is try to keep it shorter. Might have to speak a little bit faster, but let me get into it. Part three, I'm going to combine parts one and two, recap some of it, and then add in a couple things I didn't cover in those first two parts as I try to merge some of these ideas together. So let's get to it. So the thing that's really going to hit the hardest in this part three is the combination of the importance of the impact of this ape dividend and the financial status of AMC, the movie theaters. So what I'm going to do is I already have pulled up here, just to be clear, I've pulled up AMC's 10Q filing. So loading it up, it's the exact same stuff. You can look at the URLs. So the first part that I really want to cover here is this. Actually here, let's look over their numbers here. As I covered in the first part, that we know that, let's look at their net loss. They're bleeding money. They've bled money in Q2 of 2022. That's $121.6 million for the course of the first 6 months of the year. So from January to June 30th, they lost $459 million. And right off the bat, we can look at the revenue here, 1.16 million. So that's what, $1.1 billion lost, or sorry, not lost, made in revenue, 1.18 billion in operating costs and expenses. So you do the simple math. This minus this gives you this. Or it's really this minus this, technically. That's why you get the negative $16.1 million. And overall, operating loss for the first 6 months, $183 million. And as a result, we can look at their cash. They started at 1.592 million, so almost $6 billion in cash equivalents. Now that's down to $965 million. So let's take a look. In half a year, they've lost, net loss $459 million. We break it down by quarter. They have their best quarter yet so far. Coming out of the pandemic, they lost $121 million. They're down to $965.2 million. If everything remains the same and they continue on, if their quarter three is exactly same as quarter two, they have the same revenues, same costs, then they're going to bleed at least another $121 million. So what's that? 965.2 minus 121, I said, right? $0.6 million. That brings them down to $843.6 million for the end of quarter three. So keep that in mind. They're still not profitable yet. And to further hit the point on this, I just want to quickly go over, let's look at the releases. So we know that Q2 ends in June 30th. So July, what sort of movie releases do we have? Going through the line, we have Thor, right? I think. Oh, sorry, there was Minions up there. We have Thor. I don't know if there are any other big hitters. Was Paws of Fury another big one? I'm honestly not sure. Going through the line, I don't really see any other DC League. Yeah. I don't know if there are any really big hitters. July. So what we have coming out in August. Any other super ones? We have Lightyear. Was that what, Buzz Lightyear? That's coming to what, Disney Plus? Anything else? Dragon Girl. I Am Groot. That's Disney Plus. She-Hulk. No. I mean, in the end, I mean, the real point is this. Where are the big hitters? We know that Q3, I don't think Q3 we're going to have that many big hitters come out. Yeah, I'm just still going through the line. I'm not seeing big popping blockbuster movies that are coming out. And that's the thing. That E and AMC, I mean, we can look at, I can pull up the figures here, and we'll know the typical trends of movie theaters. Blockbusters tend to come out Q2 and Q4. We see it in their 2018 numbers, Q2, Q4. 2019, Q2, Q4. So we know that Q3 is not going to be good as Q2. Even in the best case scenario where, let's say, Q3 is exactly the same as Q2, they're still going to be burning money. And nonetheless, they flat out say it in their filing. The company's business is seasonal, with higher attendance and revenues generally occurring during the summer months and holiday seasons. So the next point I want to point out is that we already know that their cash on hand, is going to be down to probably $844 million if the exact same loss occurs for Q3. And don't forget that you can't expect this to be basically down to zero. Because, look, they have credit agreements that they need to hold X amount of money on hand. So, for example, we know that they have the minimum liquidity requirements of $139.5 million. $100 million required under the extended covenant suspension period, under the senior secure revolving credit facility. You got another $39.5 million under Odeon term loan facility. So they have X amount of money that they need to have on hand. Basically $140 million. So that gets me to the point of, let's pull up their debt. Their overall debt. Principal amount of corporate borrowings, $10 million for the 6 months ending in December 31st of this year, $525 for 2023. So overall corporate borrowings, more than $5 billion. That's a significant amount of money that they have no ability to currently repay because they don't have they're not making enough money quarter after quarter. The only way they can make payments is basically they've diluted the shares, and they've been, with that reduced value in the stock of the company, they've been using that to pay the interest payments on their debt. So, next part I wanted to cover here is that let's look at not only on top of the regular debt that they have, we need to consider what other payments are they behind on or they haven't paid yet. They have rent concessions. They have deferred lease amounts of approximately $218.9 million as of June 30th. That's a lot of money that they still have not paid. So the company as a whole is, you have way too much. Oops, where's their... Look at their total assets. $9.8 billion in total assets. Their total liabilities, $12.1 billion liabilities. Too much liability, not enough in assets. Paired with the fact that they don't have the cash flow to properly support all this liability. So the concern becomes this. We have... Oops, sorry, let me pull up the additional filings here. We have this ape dividend that they're creating. Hold on, let me see the exact filing here, the 8K I was looking for. They've designated 10 million shares of the preferred stock. They have that much set off, and we know the amount of 516 million X. I'm doing whole numbers here, 516 million ape units, because we know there's 516 million approximately outstanding shares. One share, one common stock share will get you one ape unit. And we know that this ape unit will be a method or tool in which that'll be used to help raise money. And as I addressed in the previous video, when you create a dividend, you're not spinning off a company. This is not the case of like a BBIG where they spin off a company, make it cryptide, and they give you a tied dividend. But nonetheless, this is a dividend in which, of the same company, the backing of this ape unit is tied to AMC Entertainment. So there is a value in what ape is, and there's a value in what AMC share what an AMC share is. You can't say that AMC has X value, and then when you create ape, you can't say that AMC is the exact same value. When you create ape, the combination of ape and AMC should equal what AMC was before. On the initial, right before the split, it should be, those two combined should be equal. So we know that the value of ape will basically subtract the initial value from the AMC share. How much that is, I don't know. But nonetheless, currently, we know that AMC, there's no way to dilute AMC directly because they don't really have any more shares authorized to dilute the company. But we know that Ape has the ability to dilute because we know that there's 50 million shares that's been authorized, of which 10 million has been authorized. We don't know the plans of when they'll authorize or they'll designate more of those shares to be sold. But we know that the purpose, as the CEO said, is to raise funds. So the simple math is this to me. Let me go back to... The company has 965.2 million cash on hand. So let's pull up to show it to everyone clearly. They currently have $965.2 million cash on hand. That's of Q2. Let's say crystal ball, we got no clue. So let's say that remains the same then. So they don't lose any money. They break absolutely even. 965.2. How are they going to pay? Where's the debt here? How are they going to start paying these debts? From where are they going to be pulling that money? That cash on hand is 965.2. We know that they need to hold minimum 135 million on hand. 525 coming out to be paid. Not to mention, let's look into some of these notes. So let's look at this 2023 Odeon term loan. 11.5% Odeon term loan due 2023 matures August 19th, 2023, during the third quarter of the company's next calendar year. So they're currently negotiating the terms of the new debt to finance this amount. So to finance the existing 147.6 and 312.2 million due in 2023. Well, sure, they want to extend the maturity dates, but we don't know if they'll be able to do that. And as so, they make the concession. I wish they'd stop doing that. If the company is unable to refinance these amounts, the principal amounts will be reported as current maturities, which may increase uncertainty regarding its ability to meet future commitments. So this is a big one. It's not like they have till the end of 2023. They have till August 19th to pay back 500. Let's convert that to USD. 523, I think they said listed. This including the other notes. How are they going to pay all that back? Will they be able to negotiate and extend the maturity dates? If the company is not able to successfully post profitable quarters, then why would companies negotiate to extend the term of the loan? It's a risky thing to do. You don't randomly just go to the bank and ask for a loan for money. The bank is going to look at, hey, how much money do you make? How much money do you have? What's your cash flow? What's your income looking like? What's your current debt situation? How much are you spending? No different from you go to buy a house. They're going to look at all that. They're going to look at your paycheck, your pay stubs, your credit score. They want to know that you have the ability to pay back this loan. So, are they going to be able to refinance this? Will they have the ability to pay this? It's a significant amount of money. And the problem is, if you burn through all your cash, 965, then how are you going to survive as a company? You want to be investing money back into your company. You want it to grow. But if you cut off all its legs, if you have no cash on hand, you won't be able to do your mergers, your buyers. You won't be able to spend money for your investments. How is their mining company, Highcroft Mine, how is their investment in that mining company doing? Is that giving them any profit? Are they getting any dividends? Is there any benefits for that investment right now? When can they expect an return on investment for that? So the thing is that this ape, in the sense of the company issuing it, it's an interesting idea. If that allows them to raise money, raise funds, raise equity, it provides an avenue for the company to continue to run on longer. Currently, the profit model does not seem to be working because they are losing money. They lost 121 million this quarter. They lost 459 million the past 6 months. Last year, same quarter, they lost 344. You look back last year, 6 months, 911. So at what point do you consider them to be doing fine? Because let's look at the attendance. Q1, Q2, 2018, 90 million, 91 million. Q1, Q2, 2019, 79.8 million, 96.9 million. So these are pre-pandemic 4 quarters. We're looking at Q1, Q2 of 2018, 2019. You got minus the 2019 Q1. Just making sure the numbers are correct. 90 million. Q1, Q2, we're still far behind. You'd have to combine the attendance of Q1, Q2 to basically reach 90 million. It has to be 98 million. But it's still, the attendance is still far behind. Sure, the revenue numbers will catch up to what they did 2018, 2019. But one thing to also consider is, hey, tickets are more expensive. Food and beverage is more expensive. Candy is more expensive. Everything has become more expensive. So we need to look at, how are their net earnings? Are they having earnings, or are they losing money? Yes, it's a good sign that attendance is increasing. But they'll even mention in all their filings multiple times. Let's see. Let's search the word attendance. Nope. Where's their guidance? Oh yeah, forward-looking statements here. If we are unable to achieve significantly increased levels of attendance and operating revenues, we may be required to obtain additional liquidity. Read that again. If we are unable to achieve significant increased levels of attendance and operating revenues, we may be required to obtain additional liquidity. Right now, they're not profitable. They're still bleeding money. Their attendance is still far behind. 59 million is far behind the 90 million they were doing. Basically 2/3 behind, so they're significantly behind on their attendance. So that's why this ape is being issued. Shareholders will not authorize the fact that, hey, shareholders don't want the stock to be diluted. They don't want the value of their share to go down. Well, the company is in a difficult situation. They're pretty leveraged. They're crazy over leveraged. Their shareholders won't let them dilute the shares. So they pulled out something from 2013 so that they could essentially raise more money. So the whole thesis right now is that the company's not profitable. Let's look at how many theaters do they have. No, do they not have? Screens. Oh, they spell it with the R-E. Okay. So, let's look at how many theaters do they have operating. 947. Let's see, do I have their numbers from before? Yes, I do. So 2018, 2019 had around 1,000 theaters. They're down to 947-ish. 947. So yes, they're replacing less profitable theaters with more profitable theaters. And they're saying that they're doing better in those theaters, but they still have far too many. They have too many that are not performing well enough. So maybe the company is too large. Maybe it has too many theaters in its system. But the problem is that if they try to sell them, will they get good value on them? Who would be willing to expand their company in this type of situation? Who would have the cash or the ability to finance this to purchase these theaters at a low cost? They'd want to get an extreme discount. AMC is picking up theaters that from other companies that are significantly smaller at discounts. Sure, it's great that they're getting these at cheaper prices, but at the expense of they're burning through all this money. A cash burn that they won't be able to sustain for much longer without raising more cash. And what happens when you raise more cash? You're diluting the value of the stock. For short-term holders of AMC, you don't want that. And for the people who are in for the supposed MOAS, this short squeeze, you're going to squeeze the shorts, well, this type of action is not going to help. If the company is going to continue to dilute the company, if they're going to have to issue more shares, they're going to have to borrow more money, they're going to have short term, the thesis continues to hold. As long as your business model does not return profit, and you have you're not showing the ability for the company to repay its debt successfully through its actual positive cash flow, then I don't see how you're going to get this short squeeze. I don't believe in this type, the whole theory of, oh, market manipulation. Oh, we're going to get the DTCC or we're going to the SEC to root out this corruption. No, I'm not going to trust or rely on these organizations to do so. Have they ever done so in the past? Not that I know of. That doesn't mean that they won't, but it seems unlikely. And I'm not willing to bet or invest my money into a company based on that. For me, it doesn't make sense. There are certainly much easier opportunities to invest the money and to make money on it. Why AMC? And let me be clear, this isn't financial advice. I'm not telling you what to do. I'm just telling you my opinions. As I said, this is my opinions on what I thought about AMC's earnings. I looked at their financial report. I looked at how much money they're bringing in, looked at their revenue, looked at their expenses, looked at how much money that they're making slash losing. They're really losing money. How much assets do they have? What's their liabilities? What's their debt looking like? When's their debt due? Do they have the ability to pay off that debt? Is the company on the right path to pay off that debt? I'm just looking at that in what I deem to be a logical manner. But in my opinion, the company is not taking the proper steps to do so. So people will ask me, then what do you think they should do? Honestly, for me, I think that the company is way too large for it to succeed. It needs to shrink down. It needs to really cut down on all the movie theaters that it's not really profitable on. They need to sell them. They need to sell them fast. Maybe this is what their plan is. They've been shedding less profitable movie theaters from 1,000 down to 947. So they shaved off more than what, 50 plus, 60? And then obviously they've added more, so they've probably shed, I don't know, 90 theaters easily. 90 less profitable ones. Well, I think that they need to do significantly more. But maybe this is the fastest that they can do it, because as I mentioned, they're not able to offload all these theaters all at once. So their only option is, hey, they need to hope that they have enough money to last themselves as they continue to make steps to cut down costs, to increase their margins, so that, hey, they can come back to being a profitable company. Albeit, let's look at it, they've never been super profitable. Q1 2018, 17 million. Q2 2018, 22 million. 49 million. They're not making a whole lot of money, even with all this attendance. We can look at their yearly revenue. 2018, 110 million for the whole year. 2019, they actually ended up down, minus 149 million. The company has not been very successful, even with high attendance rates. 358, almost 359 million, 356 million. It's just not happening. And we know 2021, 128 million. Basically 1/3 of what they did 2019. Sure, so far, that's what, 98 million. Let's say they do double that, so they're well on their way beating 2021 numbers. But even if they 90, let's do this. The sum of those two times 2.5. Even if we give them a buff for the second half of the year, 245 million. That's still far below pre-pandemic levels. So they won't be profitable for the year. So at what point will the company finally be profitable? And will that profitability be in time for them to make payments on all their loans? Once the company turns around more, I'm sure they'll have better leverage to negotiate. But that's a big if. The company's taking steps, no doubt. But I don't think that they have enough time. Only if they dilute the company's stock value to raise more money, if they dilute it more and have even refill basically their coffers with cash, maybe that'll buy them enough time. But I don't think that the company has leverage in the fact to work out these new loan payments, extended maturities, without having to perhaps having to pay increased interest rates. Nonetheless, that was my thoughts. One quick thing I did wanted to mention on top of that, I noticed going through the SEC filings, looks like BlackRock filed an Amendment 13G. If it would only load. So we can take a look. So this is for AMC. This is for BlackRock. And now we know that percent of class that they represent, 4.9%. So we know that BlackRock is reducing their holdings in AMC. Just food for thought. And I'll be frank and I'll be honest with you folks. For me, I think that leading up onto the dividend, I'm sure people that are misguided, that don't really understand how the dividend situation works, how dividends affect the value of the stock, especially when it's tied to the same company. I think that people who don't understand this, and folks that don't really understand reading these financial statements, the 10Qs, the 10Ks, the people that don't understand that, they're probably going to irrationally buy more and more shares of this company. They're going to be buying at 20, 25, 26, whatever. Maybe it goes up to 30. Nonetheless, that I think that there'll be some sort of sentiment by some retail investors, apes, and as a result, stock price might go up leading up until the dividend date. I believe that was the 15th. So I think it'll continue to go up. For me, I'll be waiting for the right opportunity to enter in puts, looking closely at the option, looking at the IV, and giving myself sufficient time on these options, put options, maybe a couple months out, but nonetheless, I'd be looking to play AMC value down to the downside. I'm closely looking at the OCC to see exactly how these options are going to be working with the dividend. So looking at the pricing of the options, see how that works. But nonetheless, I'll be honest with you folks. What I plan to do is I plan to get puts. I don't buy shares in this company at all. I played the initial run up when it went up to 72. I'll be honest, I didn't time the perfect exit at 72. I sold in the 50s. I should have sold in the 60s and 70s. I should have been slowly locking in more profits as it continued to go up. But oh well, I still made a significant amount of money that I'm happy with. And I'll continue to make moves that I believe are logical. I haven't been losing money on AMC. I've been playing calls and puts throughout the whole saga of the past year, options, and I've been making money on it. I don't have to be locking up all this capital, all this money into shares for a company that's not giving me back any money. Look at the inflation. Look at CPI numbers that just came out. We're still, 8.5%? Inflation is ridiculously high. You're letting your money burn unless that company's share stock value is going up by 8-9%. If it's not, then basically you've lost money. If you've been buying in the 50s and the stock is now in 30s, you lost $20 per share on top of inflation. Look at all the money. Look at the opportunity cost. That's just me. That's just how I invest. I'm not telling you what you folks should do, what to do. I'm just telling you my thoughts and what I do. But good luck, folks. I might do another update video, probably Friday evening. Trying to give an update as to how the company has been moving. But best of luck, folks. Until next time, Shadow Stars out.